let's go over a couple of different types of bonds. And there's a lot of, as I said before, that these instruments are customized. They're flexible. That's one of the benefits of them, that unlike a traditional bank loan where the bank sets up the terms, the company can set it up. So there's a wide range of them. So I'm just going to go over a couple of common types of bonds that you will hear about. One is a zero coupon bond. So what we've talked about before was just a plain, straightforward, regular bond, where you had the interest paid throughout and then the principal paid at the end. In a zero coupon bond, they don't actually pay any of the interest. You just get paid at the very end. Essentially, what they're doing is they're reinvesting the interest for you in the bond. And this is of use to some people that maybe don't need the monthly income. If you're somebody who needs the monthly income, you want a regular bond. But if you just want somebody who wants some to invest in something that's relatively safe and will grow over time, then you will just buy a zero coupon bond. You won't get the monthly or semi-annual payments. So if you're buying $1,000 bond, you're just going to buy it at a lower price, and it will earn interest, get reinvested, and there's a mathematical formula for what the price of that bond will be. So we'll do the actual calculation of a bond price a little bit later, but we'll do a quick example right now. With the zero coupon one is very straightforward. It involves the time value of money. But if we assume that we've got a 5-year bond and it's a $1,000 bond, so it's going to mature at the end of 5 years, the company's agreeing to pay you $1,000. So then the question is, what is it worth today? What are you loaning the company today in order to get the $1,000 in 5 years? And you, in this case, we're going to say that the implied interest rate is 3.5%. So the company is giving you, the current rates are 3.5%, and that's what they have to offer you. So you would just have to work backwards to figure out what the price of this bond is. And using the straightforward present value, time value of money formula, that would tell you that $1,000 in 5 years would be discounted by 1 plus the interest rate to the exponent of the number of years. So in this case, it'll be 1,000 divided by 1.035 to the fifth, which works out to $842. So what it says is that in this case, you would be paying $842 today, and the next cash flow would be 5 years from now when you'd get $1,000 back, and that should be theoretically equivalent to you getting 3.5% per year as an interest payment and having it reinvested throughout the life of the bond. Okay, so the next one is a floating rate bond. So traditionally bonds, like mortgage rates or maybe not mortgage rates. Mortgage rates can be either as well, but traditionally bonds will have a fixed interest rate, and you can actually get a bond set up so that it'll have a floating interest rate, which means that the interest coupons will change as the prime rate changes. So the Bank of Canada changes their rate. The interest that you're going to be paying on the bond is going to change as well. So it's not going to be a steady, equal annuity of payments. It's going to be a different amount every 6 months if it's a semi-annual bond. And it'll have some pros and cons. It'll benefit you as an investor if interest rates go up because your rate's going up, and vice versa. If the rates go down, then it would be pretty harmful. Companies don't like this as much because companies would prefer to have a fixed rate and they can plan for it, as opposed to running their operations and then finding out all of a sudden that their income went down because interest rates went up unexpectedly. So the third type is a sinking fund bond, and this favors the investor because it's meant to give a little extra added security. Because if you think of the way that bonds are set up, especially long-term bonds, you can have a lot of different interest payments throughout the life of the bond, and then your large payment, the principal, is put at the very end. Okay, so in this case, what they're doing is the company is putting aside some money in a trust to make that very large payment at the end. And that you could say, okay, well, when you buy the bond, the company's rated well, but sometimes companies can change in terms of their credit rating. They could run into tough times. The economy could The economy could change, or all kinds of things could happen. So if it's a very long-term bond, like a 10-year or 20-year bond, anything can happen to the industry. And what happens if they continually make all those payments? If you look at a situation where they're going to pay $10,000 or $10 every interest period, and then at the end they pay you $1,000, and if that is a decade down the road, and they don't have the money at that point, that's the biggest portion of cash flow, and they're going to default on it. So it's one of those things where you would be much better off to have a situation with a sinking fund where the company's been putting money aside. It gives some level of comfort to the investor, because if they didn't have the money aside, then basically they would have to go and refinance from somewhere else, that likely wouldn't be an option, and they would default on the bond.